Hello, welcome to another exciting episode of Invest with Kevin. And I'm here today to talk about the numbers you need to know for when you invest in commercial real estate properties. Now let me begin by explaining what these numbers are that I'm going to go over. I'm going to talk about your net operating income. I'm going to talk about your cash on cash return, and I'm going to talk about your cap rate. Now the first number I'm going to discuss is your net operating income. Now let me begin by discussing a hypothetical example for an apartment building that you buy as an investor yourself. This apartment building has 100 units in it, and it's worth $100,000. You as an investor are able to buy this property by putting only $20,000 down as a down payment, but you borrow the remaining $80,000 purchase price from a bank in order to buy the property. So congratulations, you are now a landlord. So this property, each unit can be rented out for $1,000 a year. I know this is unrealistic, but I'm just using simple numbers just for people to follow along. So this means your property can potentially generate $100,000 a year of potential gross income, which is all rents you could generate assuming you rent out every unit at all times of the year and all tenants pay their rent. Now, you guys subtract out as a landlord, vacancy and credit loss expenses, which are simply, losses of income you have from having vacant units, because unfortunately, you'll not always be able to lease out every unit at all times. There'll be times units will sit vacant until you find the right tenant to live there, or a tenant thinks you're the right property for them to live in. And there'll be credit losses. Remember, tenants are people too, and unfortunately, sometimes they lose their jobs or they have big healthcare expenses, and that could kind of take away their income they have to pay you as a landlord to live at your property. So all landlords, factor in that there will be some units that will be vacant, or there will be some units where the tenant does not pay rent. So we're going to assume in this case that your vacancy and credit loss expenses are 6% of your potential gross income. So that means, you're expecting that this property will lose about $6,000 a year from vacancies and losses from credit loss of tenants not paying their rent. So that means, subtracting from your potential gross income the $6,000 vacancy and credit loss expense, you're going to be left with $94,000 of what's called effective gross income, which is your gross rental revenue you'll get after factoring out the cost you'll have from having vacant units or tenants who just don't pay their rent, which is the credit loss part of that, expense item. And now we're going to begin by subtracting out operating expenses you'll have for being a property owner. One of the biggest ones you have is property taxes, followed by utilities, followed by maintenance and repair costs, followed by property insurance, and lastly, property management expense. Now, unfortunately, yes, most counties will charge you property taxes because that's just how it is. The government's going to do that. It's just an expense you're going to have to bear as a landlord. But the other expenses, like utilities, in some cases, you can get the tenants to cover that in your lease. It really depends on the market, though. But in this instance, we're going to assume the tenants are, not paying the utilities and you're paying all the utilities as the landlord in this case. And with insurance, it is always a good idea to have insurance, because what happens if your property burns down or earthquake destroys it? You need insurance so that way, if something happens, you can repair your property without having to dip into your own personal funds. And trust me, no bank will lend you money to buy a property if you do not buy property owner's insurance. They demand you do because they want to make sure their collateral, which is what they lent you money to buy, is safe. And with maintenance and repair costs, sometimes things break, I remember my first year of being a renter in an apartment in college. The microwave door I had, my roommate literally put his hand on it and he broke it off. He didn't even yank it off like the Hulk. He just yanked it off like normal and it broke off in his hand. No joke. And with maintenance expenses, that also includes things like paying people to maintain the property, like gardening, for instance, or cleaning the halls, janitorial services. I'd say another maintenance expense is taking out the trash, because surprisingly, man, for some reason, tenants tend to generate trash, and a lot of trash. Well, in fact, people tend to generate a lot of trash. I don't know why. So, now that the operating expenses, you have to pay. Oh yeah, before I go on, I forgot to mention property management expense. Not all real estate investors want to deal with tenants, so they hire a property manager whose job it is to deal with tenants and deal with their complaints and make sure they're happy and to lease out your units. So that way, you're generating as much income as you can from them. And also, property managers make sure the rent is collected in an effective, efficient manner. So let's assume in this case your operating expenses are $84,000 a year. So remember, your effective gross income is $94,000. So we subtract from that your operating expenses of $84,000 a year. That leaves you a net income of $10,000 a year just for owning this property. Now, in real estate jargon, the net income is to be referred to as net operating income, which is your net income you produce, the property produces after factoring out all operating expenses. Hear that again? That's the net income a property produces after adjusting for all operating expenses. And that's your net operating income. This number is very important because this is how properties tend to be valued. It's kind of like stocks and how they're valued based off earnings per share, for instance. Now, the next number we'll talk about with y'all is the cap rate. If you recall, your property generates $10,000 a year of net operating income, and the property's value is $100,000. If you take your net operating income and you divide it over your initial purchase price for the property of $100,000 and express that answer as a percent, then your answer is going to be 10%. That means each year your property generates 10% of its value as net income after factoring out operating expenses. Now, a cap rate is simply short for capitalization rate, and that's pretty much a relationship between your net operating income and your property's value. And it's calculated as I explained before. Your net operating income divided over your cap rate. Your net operating income divided over your property's value to generate a percent. In this case, your property generates 10% of its value each year as net income after factoring out operating expenses. Now, you need to know the cap rate because, cap rates depend on the market, they depend on the property, but generally, if investors are looking to purchase properties, say, get a 10% cap rate, then, it's actually a way to value the property. If you have enough market research to prove that investors want to buy properties only if they get a 10% cap rate on them, then you can actually value a property with your net operating income. So you could actually do the reverse. Instead of taking $10,000, you see your net operating income and dividing it by your purchase price to get 10%, you can actually figure out your property's value by taking your $10,000 net operating income and dividing it by your cap rate, the market cap rate of 10%, and that equals $100,000. So you can figure out what a property is worth. Now, cap rates depend on the market. They could be high, they could be low. It really depends. Generally, they're high if it's like in a case where they're like 8% or 9%. Let's say, for instance, with this property you bought for 10% cap rate, you buy it at a 10% cap rate, but let's say the cap rate drops to 5%. Remember, you can value the property by taking your net operating income and divide it over the new cap rate to get the new property value. So in this case, if you take your net operating income of $10,000 and you divide it by the new cap rate of 5%, then your property's value has doubled from $100,000 to $200,000. That's a pretty cool way to make money, isn't it? So when you're an investor, like in real estate, you want to see falling cap rates because it means your property's going to be worth more. It's like the equivalent of buying a stock and seeing investors pay more for a stock in regards to its earnings, in terms of like price to earnings, where they instead of paying 20 times, earnings, they might pay 40 times earnings. But remember, the reverse also is true in real estate, where if cap rates are rising, that means investors are going to pay you less for each dollar of earnings you have because of the fact, they need to get that higher cap rate the market demands. So let's say in the instance where your property you bought, for $100,000 and it generates $10,000 in net operating income. Let's say that this property sees the cap rate rise, the market cap rate rises from 10% to 20%. So if you take your net operating income of $10,000 and you divide it by 20%, then the property is only worth $50,000. So it's important to keep an eye on cap rates and in the direction they're trending. They generally do not rise or fall dramatically like they do with stocks. And that's one of the reasons why people like investing in real estate. It's a very stable, safe investment that tends to rise over the long run. But I'm just giving you that as an example to explain to you why, as an investor, you want to focus on lower cap rates. Like, you want to see your properties be bought, at high cap rates and see the cap rate go down because it can give you a big windfall, As I mentioned, if you buy your property here and get a 10% cap rate where it's worth $100,000, but let's say the income stays the same but the cap rate drops to 5%, then that means investors are now willing to pay for your $10,000 net operating income at a 5% cap rate. If you divide your net operating income over your cap rate, then your property is now worth $200,000, double what you paid for it. So remember, as an investor, you would like to see cap rates go down so you can make a huge windfall from appreciation. Now, the next number I'm going to talk about with you all is your before-tax cash flow. Because remember, your property was purchased with a mortgage, so that means you got to pay the bank back the money you borrowed plus a fee to borrow, which is known as interest. So you're going to make payments to the bank each year, which total $6,000. This is going to cover principal, which is the amount you originally borrowed, and interest, which is the fee the bank charges for using their money. So before-tax cash flow is calculated by subtracting from your net operating income your debt service expenses of $6,000. So remember, your net operating income is $10,000, and your mortgage service payment, your debt service payments, that's $6,000. So $10,000 minus $6,000 is $4,000. This means this investment is generating before-tax cash flow of $4,000 a year. And now I'm going to lead you to the final number I'm looking forward to talking about with you all, and that's your cash-on-cash return. This number measures the relationship between your before-tax cash flow from the first year of property ownership and your initial investment of money you personally put into the property. If you recall, you originally put down $20,000 to buy this property as your initial cash outflow from your own personal net self, your own personal savings. Remember, you borrowed the other $80,000, so that other $80,000 is not your personal investment. Only your down payment of $20,000 is your personal investment. So in order to figure out the cash-on-cash return, take your before-tax cash flow of $4,000 and divide it over your initial investment of $20,000 and express that answer as a percent. That's 20%. That means by buying this property, you're going to earn 20% on your money just from the cash flows in the first year of ownership. That is not bad, honestly. But you want to know the cash-on-cash return so you can compare this investment opportunity with other investments to see how it compares. Maybe there's a property you can buy where you can get a 25% cash-on-cash return. Or maybe you can only buy a property where you get an 8% cash-on-cash return. You want to know your cash-on-cash return from a property so that way you can see how this investment compares to your other investment options you have out there. I mean, maybe, you might decide 20% is not enough. That you may rather say, I might just buy a stock instead and try to hope for 25%. But you might say, you know what, I'm going to stick with real estate because it's a nice, stable, safe investment. So I'm only going to focus on real estate investments. And it turns out, after comparing my options, I think getting a 20% cash-on-cash return is better than maybe other properties where I can earn, like, say, a 7% cash-on-cash return. Thank you all for watching. I hope you liked the video. Make sure to like, subscribe, comment, and please advise me on what you want me to talk about next in regards to real estate, personal finance, and investing. And also, before you go, remember, those who smash the like button tend to, on average, see their stock portfolios grow by 10% over a 1-month period. So make sure to smash that like button. Oh, and also, before you go, if you want 2 free stocks, make sure to use the link in the description below where, literally by signing up for Webull, you can literally get 1 free stock for joining and get a 2nd free stock for depositing over $100. So, thank you so much for watching. I look forward to seeing you for my next episode.